Hi, and welcome to episode 56 of Oil Matters on Wednesday, the 26th of November. Crude futures have eased in the last fortnight, with ICE Brent closing last night at $62.48, NYMEX WTI at $57.95. Physical North Sea dated has moved above futures, mirroring a doubling in the last 2 weeks of M1 minus M3 backwardation for Brent, even though longer dated prices remain clearly in contango. With ongoing OPEC plus supply increases through December, sour crude grades generally have weakened, and rising US Gulf production has also played a role in that. The implementation late last week of new US sanctions on Russian producers Rosneft and Lukoil, which together account for around 2.8 million barrels per day of Russia's total 5 million barrels per day of crude exports, has eroded prompt demand for Russian crude into India, Turkey, and China, at least temporarily. Tanker data imply that India's December Russian crude imports may be only around 1/3 of November's 1.87 million barrels per day. With the EU also implementing from January a ban on imports of refined products derived from Russian crude, Asian refiners have been scrambling to source alternatives to Russian barrels, driving up eastbound freight rates into the bargain. The discount for Urals crude FOB Primorsk has widened to $22.45 versus North Sea dated, its steepest discount since mid-2023. On paper, of course, President Trump's latest peace plan for Russia and Ukraine holds out the potential not only for a welcome end to the conflict, but also some easing of sanctions on Russian energy exports. This at least seems to have been the rationale for the crude market softening evident over the last week, even though it remains highly uncertain whether Moscow and Kiev can reach an agreement on mutually acceptable terms. Indeed, even President Trump has backed away from an initial deadline of this Thursday for the two sides to reach a deal. So for now, the crude market continues to resemble Beckett's Waiting for Godot, anticipating a surplus that is yet to materially filter into OECD industry stocks, amid soft global oil demand growth, chunky non-OPEC supply increases, and tapering OPEC plus supply cuts. Countering crude's bearish narrative so far in 2025 have been Chinese crude stockpiling and a seemingly endless list of geopolitical flashpoints that continue to raise question marks over the ample supply thesis. The Ukraine conflict and its impact on Russian refining availability has tightened global diesel supply, as witness recent $40 per barrel European diesel cracks. The onset of winter heating demand, Europe's looming product import ban, and elevated demand for marine gas oil after the IMO's tightening of Mediterranean sulfur specs also seem likely to support diesel cracks in coming months too. On the crude oil side, while a peace deal for Ukraine could theoretically ease stretched Russian crude and products supply chains, for now that still seems a distant prospect. In addition, Sudanese crude oil flows to the Red Sea once again appear prone to disruption amid worsening conflict there, while industry sources remain to be convinced about the durability of Yemen's Houthis' claim to have ceased attacks on Red Sea shipping. Meanwhile, the presence of a U.S. military flotilla in the Caribbean and tightening U.S. sanctions on a Venezuelan drug cartel, which Washington claims President Maduro profits from, also raise questions over Venezuela's 800,000 barrels per day of crude exports. So this long-running dynamic equilibrium between seemingly bearish oil market fundamentals on the one hand, but more supportive geopolitical risk elements on the other, probably has further to run. That's all for now, but check out Argus Global Markets and Petroleum Argus this Friday for all the best in pricing, news and analysis. And for those of you planning to be stateside in early February, go to argusmedia.com to sign up for our Argus America's Crude Summit that's happening in Houston between the 2nd and the 4th of February. Bye for now, and see you next time for another Oil Matters from Argus Media.